All right, guys, can you all hear me now? Okay, good. All right, one more time. This is my name and this is my email address. All right, your attendance will be taken as long as you log in, your attendance will be recorded. All right, this is our first lesson on principles of accounting. Now, just a few items before we go through the actual lesson. This is your student guide. Okay, let me show you some important things that you're supposed to know. All right, for this module, your assessment will be as follows. Okay, there will be 2 online tests. This is known as your coursework. Okay, they will contribute a total of 30% to your overall grades. At the end of the term, you will sit for final exam. Okay, the exam will be 70%. Total 100%. Now, for the online test, I will let you know more when we come closer towards the date. All right, but it will be like this. The first test will cover topic 1 and 2. The second test will cover topic 4 and 5. Okay, the test date I will announce in class. Now, in between, if you have any questions, okay, you can type in the chat box. Okay, and I'll try to answer your questions as and when I can. Okay, just a minute. I try to adjust my mic. Okay, is it better now? Okay, is it better now? Can the rest of you hear me? All right, guys. Okay, I try to adjust the mic. Is it better now? Okay, now for those of you who can't hear clearly, can you please adjust your, okay, can you please adjust your sound? All right, so this is our first lesson. Okay, now this first lesson is on the introduction. This is an introduction into accounting. So I'll give you a very brief overview into what accounting is all about. Okay, and as we go along, we'll be covering more of these items. All right. So today is just to give you a brief overview into what accounting is about. All right. First of all, what is accounting? Okay. Accounting is actually a process. Okay, a process of identifying, recording, communicating the information. All right. So there are three things in accounting. First, you have to identify the transaction, what happened in a business. Second, you need to record them down. And thirdly, you need to be able to communicate this information. That means to report, okay, this information. Oh yeah, yeah. Okay, whenever I write on the screen, you may hear some sound, all right? But it should be quite marginal. Because when my stylus pen touch the screen, okay, there'll be some sound there. Okay? Alright. Good. Alright, so this is the whole process of accounting. There are three things. You need to identify what happened in a business. Secondly, you have to record them down. And thirdly, you need to prepare the report. Now, over the course of the next few lessons, we are going to go through this process. For example, in topic number 2, we will learn the recording process. How do we record down the transaction? Okay, and then in topic 3 and 4, we will learn how to communicate, how to prepare the report. Okay, so for today, I just give you the introduction. Now, who do we report to? We communicate this information to the users. The users are the people who need this information. And who are the users of accounting information? We can divide them into two main groups. We have the external user and we have the internal user. The external user are those people that are outside of the organization. Example, we have the lenders, the shareholders, the government, the consumer groups, and so on. These are the people outside of the organization. They are known as the external user. The internal user refers to those people that are inside the organization. So they will include people like the managers, the officers, the internal auditors, the sales staff, okay? All those people working inside the organization. These are the internal users. Now the difference between external and internal user is this. Accounting can similarly be divided into two main groups. We have the financial accounting and the managerial accounting. Financial accounting deals mainly with the external user. Managerial accounting deals with the internal user. Now you'll notice that the word managerial accounting comes from the word manager. So basically they prepare reports for the manager, the internal user. Alright, why is accounting important? Okay. Now, just to give you a brief overview, a whole picture, you will notice that the owners or the shareholders of the business, they will contribute capital. Okay? They will contribute money to start the business. Then the business will use this to buy assets, okay, to pay for expenses, and then they will sell the stuff and earn money for the company. And all these are known as transactions, and all this has to be recorded. At the end of the year, the accountant will need to prepare the reports. Okay? They need to prepare the reports, and this report comes in the form of financial statements, okay, which we will look at in topic 3 and 4. So these reports will then be given to the users. Of course, we have both the internal as well as the external user. So in a nutshell, this is what accounting is all about. So far, so good? All right, next. Now, the next thing we want to talk about is the principles, the rules. Now, accountants have to follow certain rules or certain guidelines. Okay? Now, these rules or these guidelines are known as the generally accepted accounting principles. Or for short, we call this the GAAP, the generally accepted accounting principle. So financial accounting practice is governed by this concept or rules known as the generally accepted accounting principle. But why? Why must accountants follow rules? Can't we let accountants be creative, let them do what they want? Well, the important thing is accountants have to follow certain rules because the information that they provide must be relevant, must be reliable, and must be comparable. So if all accountants follow the same rules and the same principle, then whatever result will be comparable. All right, we have a student here. Now, if you cannot hear the voice, okay, can you please adjust your volume? Okay, ask the rest and here. All right, okay. All right, this is why accountants have to follow certain rules. Okay, this principle. Now, let me give you an example. Let me illustrate. Okay? Now, this accounting assumption or principles are the guidelines that accountants have to follow. This become their standard. And let me give you a certain example. Now, you can call this the principles, the assumptions, or the constraint. I'll give you some examples. Okay. For example, accountants have to follow 4 principles when they prepare their accounts. Okay. Now, these 4 principles are as follow. There's a measurement principle, there's a revenue recognition principle, expense recognition principle, and so on. Now, let me give you an example. Okay, look at the first one. All right, the first one is the cost principle. Now, under this principle, it is stated that accountant will record based on the actual cost. So I give you an example. For example, if you buy a machine, the cost is $5,000. The cost is what you actually paid for. Okay, you actually paid $5,000 for it. Now, but some people think that this machine is very special. Okay, this machine should be worth much more. It should be worth $7,000. Now the question is this: when you record the cost of this machine, the value of this machine, should you record at 5,000 or should you record at 7,000? Well, based on the cost principle, it is stated that accountant must record at the cost. This is the actual price you pay for it. Okay, so it should be based on 5,000 because you will have the evidence, the proof, okay, that you pay 5,000 for it. You can show the receipt. But this value 7,000, this is debatable. Are you sure you can sell it for 7,000? So based on the cost principle, we should record it at $5,000. And because everybody, all the accountants followed this same principle, there will be no argument. So when you prepare the report, it doesn't matter whether you are an accountant in Singapore or you are from China or you're from anywhere in the world, we will all agree that the machine is $5,000. Are you with me? And because everybody follow the same principle, there's no argument. So whoever prepare your reports will come to the same conclusion. This is what is meant by the accounting principle. So far, so good. Okay, good. Now, then there's the revenue recognition principle. Now, many of these things we'll go through again in details when we come across it again in a subsequent chapter. But today, I just want to give you a brief overview, a brief picture, why we need to have, why accountants need to follow this principle. Okay, so one more time, what is this principle known as? GAAP. Now, remember I told you that you will have to sit for 2 online tests. Okay. The online test will comprise of 30 multiple choice questions. And one of the favorite questions, they will ask you, what is GAAP? Can anyone tell me what is GAAP? GAAP is a generally accepted accounting principle that all accountants have to follow. And why do we need to follow this rule? So that whatever information that is provided, it will be relevant, it will be reliable, and it can be comparable. And why is it comparable? Because everybody follow the same rules, they will end up with the same result. Are you with me? Alright, this is what the generally accepted accounting principle means. Now at this stage, I will not go through all these principles with you because we will come to it when we come to the subsequent chapters later on. Alright? Any questions? Alright, good. Okay, so at this stage, I will not go through the details review. Alright, we'll leave that at the subsequent chapter. Alright, now the next thing I want to discuss with you is the different form of business entity. The different types of business. Now, the simplest form of business is called a sole proprietor. There's only one owner. Most business started off as a sole proprietor. Now, for example, after school, after this diploma program, some of you may not want to work for others. You may want to start your own business. You may have a good business idea and you want to start your own business. You can start off as a sole proprietor. In a sole proprietor, there's only one single owner. You make all the decisions. But as your business expands, you notice that one person cannot handle everything. You will bring in your friends and your relatives to join you in business. This is known as a partnership. A partnership, you have two or more owners. Now, as your business expands even further, you may find that a partnership cannot handle everything. Then you may want to make it into a corporation or a company. A company can have many owners, unlimited owners. The owners of a company are known as the shareholders because they share in the company. So there are basically three forms of business entity. You have the sole proprietorship, you have a partnership, and you have the corporation or the company. Now, for our purpose, at the diploma level, at this level, we will only be focusing on a sole proprietor. So whatever accounts that we are preparing for a sole proprietor. Now, as you progress further, when you further your studies, you carry on to do your degree and so on, then you will learn about partnership and companies accounting. But whatever we learn for sole proprietor, we also apply for partnership and corporation. Of course, except for partnership and companies accounting, there will be more details. Okay, there will be more details. All right. All right. I see a question here. Now, those of you who cannot log in for whatever reason, you may call the PSD, hotline. Now, another thing is that this lesson is recorded. Okay? If you miss this lesson for whatever reason, you can always play back the recording at a later date. Alright, so in the meantime, you can call the PSD hotline or the PSD email address and let them know about your problem. Okay? Alright, next. So a sole proprietor is a small business, okay? A one-person owner. Oh yeah, hey, by the way, guys, class, do you know that you don't have to take down any notes because all these slides, they are available on Blackboard. Okay? It's available on Blackboard. You can download it, you can print it out, or you can view it on your mobile devices. Okay, so there's no need to record down the notes. Okay? So a sole proprietor is the simplest form of business ownership. Okay? Anybody can start a business as a sole proprietor. Now, as the business expands, you will want to form a partnership. A partnership is owned by two or more people. All right. Now, the corporation or the company is the biggest form of business organization. All right, they have many shareholders. So as I said, for this particular course, we will only be focusing on the sole proprietorship. So whatever we do, all the accounts will only apply for sole proprietor. Yeah. Right. Next. Now, the next topic I want to cover with you is on this accounting equation. This is perhaps the most important equation you will learn in accounting. This equation is known as the accounting equation. We will come across this again and again and again. All right. So what does the accounting equation state? It states that your assets, whatever you have, whatever you own, is equal to your liability, whatever you owe, plus your equity. Now, this word equity, I'm going to add in the word owners in front. So this is called the owner's equity. Okay, so I'm going to rewrite this in short form. All your assets A, whatever you have, must be equal to your liability, whatever you owe, plus the owner's equity, OE. This equation is known as the accounting equation. All right, we will come across this equation and again. Now, let me give you an example. Okay, how this works. For example, if you buy a house, let's say the house is $1 million, but you don't have enough money to buy the house. So you go to the bank and you took a bank loan. Okay, you borrow $800,000. Let me ask you a question. What is the house? Okay? The house is what you own now. This is your asset. So your house is $1 million. Your asset is $1 million. But because you took a bank loan of 800,000, your bank loan is your liability. It is what you owe. So your liability is $800,000. Now you tell me, how much of the house belongs to you, belongs to the owner? So your owner's equity will be $200,000. Are you following? Very good, 200,000. Okay, so this is the meaning of owner's equity. They must always be equal. Okay, your assets, the house, comes from the bank loan 800,000 plus 200,000 from the owner. This is known as the accounting equation. So whatever you do, this accounting equation must always be equal. That's why it is called an equation. Yeah. All right. Now, at this moment, I want to spend some time going through with you what are these items. First of all, what is an asset? Okay, what is an asset? Now, an asset must have three qualities. Number one, asset must have a value. Number two, there must be ownership. Number three, the assets must be able to provide you benefits in the future. All right. So for example, okay, if you pass by, okay, if you pass by Bukit Timah area in Singapore, and you see a very nice house, okay, and you like it very much, can you say that the house is yours? Can you say that the house is your asset? Now, let's see whether it satisfies this condition. Number one, the house is very nice. It must be very expensive. It has a value. Yeah. Number two, but you have no ownership. When you see something, it doesn't mean that it is yours. Okay, you don't have ownership. It is not your property, so it cannot be your asset because there's no ownership. The house belongs to who? The house belongs to the owner. Okay, this house is the asset of the owner. It is not your asset. Are you with me? Because you have no ownership. And the next thing, to the owner, why is the house considered the asset? Because the house will provide economic benefits in the future. The owner can stay in the house, the owner can sell the house, and the owner can rent out the house. So it must be able to give you benefits in the future. This is what is meant by an asset. Are you with me? So now here I want to show you examples. Okay, examples of assets. We have our cash, we have inventory, we have land, buildings, equipment, supplies, vehicles, accounts receivable. Now, at this stage, especially those of you who have no accounting background, many of the terms here are new to you. Okay, but don't worry. Here I'm just giving you a brief overview, a brief introduction. I will explain to you in more details the next time we come across it. But at this moment, I just want you to know something. Can you see that all these are their assets because all these belong to the company? Okay, belongs to the organization. So there's ownership. Number two, can you see that all these items will be able to provide benefits to the company in the future? Okay. Now I want you to think of it. What benefit does cash provide? The company can use the cash to pay for expenses, to buy the things that they need. Okay. What, are, what about land? Well, the company can sell away the piece of land, or they can use the land to build a new factory. Okay? Machine, equipment, all these will be able to provide benefits to the company in the future. So, can you see all these are examples of assets because they satisfy these three conditions. So far, so good. All right, let me test you now. Okay? Now take the case of TSD. Okay, let's use TSD as an example. Now, can someone give me example of assets of TSD? Okay, can someone give me the examples assets of PSD? Okay, very good. We have the classroom, the camera, the computers. Okay, well done. Now, of course, even now, especially now, we are not in the physical classroom, so you don't see it. But you can imagine, okay, PSD, the classroom, the equipment that we have, all these are examples of assets. Okay, very good. And why are these assets? Because number one, all these items are owned by PSD. Number two, all these have a value. And number three, all these will provide benefits to PSD. Okay. Now, let me ask you a question. What about the lecturer? Okay. Okay, me. Am I an asset of PSD? Yes or no? Okay, interesting. We got some who say yes, some who say no. Okay, now let me ask you a question. Let's go back to the basic definition of an asset. Okay, now let us take the example of a lecturer to PSD. Okay, me. Number one, do I have a value? Yes, I want to think so. Okay, I have a value. All right. Number two, can I provide benefits to PSD? Yes, yes. I also provide benefits. And what benefits does the lecturer provide to PSD? Okay, the lecturer teach the student. Okay, so but why am I not why? So am I considered? Is the lecturer considered an asset to the school to PSD? See, we have condition number one. I have a value. Number two, I provide benefits to the business. But why am I not an asset to PSD? Because there is no ownership. Okay? No ownership. Okay, I'm not a slave. Okay, I'm not a slave to the school. I'm not owned by the school. So as long as it doesn't satisfy all these three conditions, it is not an asset. Do you follow? Now, somebody asked a question. What about students? Are students considered assets of PSD? Okay, let us go through these points again. Yes. Okay. Number one, are students valuable to PSD? Yes. Okay. You are our most valued client. Okay. So you are definitely valuable to the company. The school cannot survive without students. Number two, does students provide benefits to the school? Definitely. Okay. Because you are the one who pay the school fees. Okay. But again, the same thing. Do you have ownership? Does the school have ownership of the students? No. Okay. You are free. You are not a slave of the school. So if you cannot satisfy all three conditions, it is not an asset. Are you with me? Okay. So this is the meaning of an asset. Now, very often, sometimes the same term, we use every day. Okay, in our everyday life, it, it has not the same meaning as we use it in accounting. In accounting, when we say an asset, we are very specific. Okay, an asset must have all these three conditions. Okay, so this is the meaning of an asset. So far, so good. All right, next. So these are examples of assets. Now, number two, what is a liability? Okay, what is a liability? Now, in simple terms, a liability is whatever you owe. Anything that you are owing is called a liability. Now, let us see how we define liability in accounting. A liability is a creditor's claim on your assets. Now, this word creditor, okay, now let me explain to you what is a creditor. Creditor are people whom you owe money to. Okay, these are your creditor. So when you have a liability, say for example, you borrow money from the bank, okay, a bank loan. Remember, when you buy the house, you borrow $800,000 from the bank. So you have $800,000 bank loan. Now, when you take a bank loan, you have an obligation now. That means you owe the bank something, there's an obligation. And when you owe something, there's an obligation to repay back. Okay? To pay back in the future. So this is what a liability is. You are owing something now, okay? And you have to pay back in the future. In other words, in the future, you have to forego something of benefit. Either you have to pay back in cash or you have to pay by time. Okay? This is what a liability is all about. Alright? So examples. Examples of liability in business. We have the loan, we have accounts payable, we have a bank overdraft, we have a wages payable. Now again, at this stage, I will not go through with you in detail, but I just want to let you know, all these liabilities are whatever the company owes. Okay? Now, the next time when you see this word payable, anything that is payable, the word payable means anything that you're supposed to pay but have not paid yet. In other words, you are owing. That is what a liability is all about. Okay? So all these are examples of liability, whatever you are owing. Alright, now that we know what is an asset, what is a liability, now can you tell me what is owner's equity? Okay, now the word equity actually means value. Okay, equity means value. So equity, owner's equity is whatever value belonging to the owner. This is called owner's equity. Now, how do we define owner's equity? You remember we learned what is an asset, we learned what is a liability. Now tell me, what is owner's equity? Okay, remember your accounting equation, A equals to L plus OE. Asset equals liability plus owner's equity. Therefore, owner's equity must be equal to all your assets minus all the liabilities. Does that make sense to you? In other words, if you take whatever the company has, all the assets, minus away whatever they owe, all the liabilities, the balance, the remainder, the balance belongs to the owner. Does that make sense? Okay. Now go back to the example of the house. The house is your asset, it is worth $1 million. But you took a bank loan 800,000. The bank loan is your liability. So, how much belongs to the owner? The owner's equity will therefore be 1 million minus 800,000. Right? So you get an equity of 200,000. Are you all following? Okay. So this is what equity is all about. Okay, this is what business equity is. So far so good. All right. But I want you to look at it on another angle. So let me write it down here. The accounting equation A equals to L plus OE. All right. But what is owner's equity make up of? Now, before we look at this, I want to show you another equation. This is known as the profit equation. Okay, can someone tell me how do you calculate profit? Profit equals to what? Okay, how do we calculate profit in a business? Now, profit is equal to revenue. Okay, very good. Somebody has the answer already. Now, profit is equal to revenue, whatever the company earns, minus away the expenses. Okay, whatever the company have to spend. So let me rewrite this in short form. Profit P is equal to revenue R minus expenses E. Okay, so this is profit. All right, now let us look at this accounting equation again. The owner's equity. Now the owner's equity, so we have A asset equals to L plus owner's equity. Now the owner's equity is made up of his capital. Whatever the owner put into the business is called capital. So we learn a new term, capital. Capital is whatever the owner invests in a business. We call it capital. So owner put into the business, we call capital. Whatever the owner take out, okay, we call it withdrawal. Or we are going to use this word called drawing. Okay, so one more time. Whatever the owner invests in a business, we call it capital. Whatever the owner take out, it is called drawing or withdrawal. Okay. So whatever belongs to the owner depends on how much he put in capital. Depends on how much he take out. Now, so if the owner put in capital, his equity, his value will go up. But when the owner take away from the business, his value in the business will drop. So we have the minus sign. Okay, let me rewrite this. Minus join. Are you all following? Alright. But what about the profit? Now, whatever profit that the business earns, can you tell me this profit belongs to who? Whatever profit that the business earns, this profit will go to the owner. Do you agree? So we have plus profit P. But tell me, what is profit? We already said profit is revenue minus expenses. So instead of writing profit, we have revenue minus expense. Are you all following? Alright, let me erase all this first. So remember, we have the accounting equation here. Accounting equation, right? Now, we have the profit equation here. If I combine the two together, we will get this. So let me rewrite this again. Asset A, whatever the company has, must be equal to the liability, whatever the company owes, plus capital minus drawing plus revenue minus expenses. Are you all following? Now, this is our extended accounting equation. Now, in business, everything in business can be classified into one of these items. That means to say, whatever you see in a business, it is either an asset, a liability, a capital item, a drawing, a revenue, or an expense. Okay? So these are the main items in a business. Okay? Now, and why is it there is a plus sign and a minus sign? Okay. Let me rewrite this. Drawing. Now, this item here, all these belong to the owner. So this is under OE. Okay, the one in brackets is under OE. Now, but why there's a minus sign, there's a plus sign? Now, the minus sign is just to show you when there's drawing and there's expenses, the value of the owner will drop. That's why there's minus sign. But when there's capital and there's revenue, the value to the owner will go up. Oh, so you have plus and minus. All right, so there you are. This is the accounting equation. So far, so good. Any questions? All right, now, so this is what the accounting equation is all about. Now, after the break, I'm going to show you, okay, how different transactions affect your accounting equation. But whatever the impact, the accounting equation must always remain equal. Okay? It must always be balanced. Your asset A must always be equal to your liability L plus owner's equity O. Okay? Alright, we'll look at this after the break. Now, in the meantime, do you have any questions? Alright, very good. Alright, if there are no questions, shall we take a break here? Okay, you have 20 minutes. Alright, please come back at 9:40. Sorry, 20 minutes, 9:50 a.m. Okay? Alright, if there are no other questions, I'll see you back later, okay? Same channel. Alright? So in the meantime, I will unmute, okay? Or rather, I'll mute my mic, alright? Alright,